The man who broke the Bank of England, George Soros' Untold secret. Imagine entrusting a modest sum to a financial mastermind and watching it transform into a fortune capable of reshaping your destiny. This is the electrifying story of George Soros, a legendary investor who turned a small stake into billions, toppling currencies, and earning the fearsome title of the man who broke the Bank of England. With an uncanny ability to spot market vulnerabilities and a revolutionary theory that rewrote the rules of economics, Soros became a colossus in the financial world, striking fear into governments and inspiring awe among traders. His journey is not just a tale of unimaginable wealth, it's a blueprint for mastering exchange rates, decoding human behavior, and seizing opportunities in the wild, unpredictable arena of global finance. Strap in as we unravel the gripping saga of Soros' rise and reveal the secrets that can empower you to conquer the markets in today's turbulent world. Born in Hungary to a Jewish family, Soros navigated a childhood marked by upheaval before pursuing education in Britain and diving into the heart of America's financial markets. His intellectual spark came from philosopher Karl Popper, whose ideas inspired Soros' groundbreaking reflexivity theory, and like traditional economics, which assumes investors are rational actors making decisions based on complete information. Soros saw markets as chaotic ecosystems driven by human biases, emotions, and perceptions. Investors don't merely respond to prices, they shape them. This dynamic interplay between belief and reality creates cycles of opportunity for those bold enough to act ahead of the crowd. Reflexivity wasn't just a theory for Soros, it was a weapon, honed to perfection, that fueled his meteoric rise to billions. Consider the housing market to grasp reflexivity's power. Conventional wisdom suggests you'd buy a property based on its rental income, calculating its value using a standard rent-to-price ratio. If a house generates a certain monthly rent, you'd pay a price that aligns with expected returns, assuming a stable market where value reflects fundamentals. Soros rejected this. He understood that investor psychology could push prices far beyond rational levels. If you believe a house's value will skyrocket, you might pay more than its current worth, banking on future gains. Your purchase signals confidence, sparking a bidding war as others follow suit, driving prices higher in a self-reinforcing cycle. But the opposite is also true. A wave of pessimism can trigger a collapse, as falling prices feed fear and more sales. Soros' genius lay in spotting these cycles early, positioning himself to profit whether markets soared or crashed. This principle of reflexivity extends far beyond real estate. It's the key to decoding financial markets, especially currencies. Exchange rates, the value of one currency relative to another, are shaped by a complex dance of supply, demand, and sentiment. Trade balances, capital flows, and market confidence drive these rates, but governments often intervene to stabilize them. Fixed exchange rate systems, like the one Europe adopted decades ago, lock currencies into set values, requiring central banks to defend those levels with reserves. Floating rates, by contrast, let markets dictate value, granting governments flexibility in monetary policy but exposing economies to volatility. Soros saw that fixed systems, while designed for stability, often hid structural weaknesses, cracks he could exploit with devastating precision. His most iconic victory targeted the British pound. Europe's exchange rate mechanism aimed to unify currencies by pegging them to each other, often anchoring weaker economies to Germany's powerhouse mark. When Germany raised interest rates to fund its ambitious reunification, the mark strengthened, putting immense pressure on currencies like the pound. Britain, grappling with economic stagnation, needed low interest rates to spur growth, but the ERM forced it to match Germany's high rates to maintain the pound's peg. Soros spotted the flaw. Britain's economy couldn't sustain an overvalued pound. He predicted that market forces would overwhelm the Bank of England, forcing it to abandon the peg and let the pound devalue. Soros didn't just foresee this, he orchestrated it. Through his quantum fund, he launched a massive short-selling campaign, dumping pounds into the market to drive down their value. To amplify the chaos, he took to the media, boldly proclaiming the pound's inevitable collapse. His words ignited a firestorm as investors worldwide joined the sell-off, creating a tidal wave of pressure. The Bank of England fought desperately, spending billions in reserves to buy pounds and prop up the currency. But Soros's bet was too bold, his strategy too relentless. Britain capitulated, exiting the euro and letting the pound plummet. That fateful day, known as Black Wednesday, cost the British government billions, while Soros walked away with $1 billion profit, earning his place in history as the man who shattered the Bank of England. This wasn't a one-time feat. Soros applied the same playbook to other currencies, targeting Mexico's peso and Thailand's baht, each time exploiting misaligned exchange rates and economic vulnerabilities. His success hinged on understanding the Mundell-Fleming model, which reveals a critical truth: no nation can simultaneously maintain a fixed exchange rate, free capital flows, and independent monetary policy. This impossible trinity means governments must sacrifice one goal, creating opportunities for sharp-eyed investors. Britain's ERM commitment tied its hands, leaving it defenseless against Soros's assault. His reflexivity theory allowed him to harness market psychology, turning predictions into self-fulfilling realities by driving herd behavior. But Soros's brilliance went beyond currencies. Through his quantum fund, he capitalized on trends in real estate, oil, and Japan's booming economy, consistently reaping massive profits. His ability to fan the flames of market trends, whether by betting big or shaping sentiment, set him apart. Unlike traders who follow rigid formulas, Soros thrived on adaptability, diving into markets with surgical precision and exiting before the tide turned. His audacity was matched by discipline, ensuring his risks were calculated and his losses minimized. This blend of vision and pragmatism made him a financial juggernaut, feared by central banks and admired by those chasing wealth. So, how can you harness Soros's lessons in 2025 as global markets pulse with volatility? First, embrace reflexivity. Markets aren't driven by cold logic, they're fueled by human emotion. Learn to read sentiment, not just numbers. Platforms like X amplify these signals, as seen in the meme stock frenzies where retail traders drove prices to dizzying heights. Watch for shifts in crowd behavior, whether it's crypto hype or Forex panic, and position yourself early. Second, master exchange rates. Currencies are the lifeblood of global finance, influencing everything from stocks to commodities. Track interest rate differentials, trade balances, and central bank moves. If one country hikes rates while another holds steady, capital flows to the higher-yielding currency, creating opportunities like those Soros seized. Third, prioritize risk management. Soros's bets were daring but never reckless. He backed his moves with exhaustive research and hedged against losses. Diversify your portfolio across asset classes: stocks, Forex, bonds, and commodities to weather market storms. Never risk your entire capital on a single trade, no matter how certain it seems. Fourth, stay agile. Soros didn't cling to losing positions or rigid strategies. In today's markets, with $50 trillion in quantitative easing inflating asset prices and geopolitical tensions sparking volatility, adaptability is your edge. Pivot when the data shifts, and don't let ego lock you into a losing bet. Fifth, think globally. Soros's victories span continents, from Europe to Asia. Monitor global trends: China's economic policies, U.S. Federal Reserve actions, or emerging market shifts. A rate hike in one country can ripple across borders, impacting everything from oil to tech stocks. Finally, start small but dream big. Soros built his empire from modest beginnings, testing his ideas before scaling up. Use demo accounts to practice Forex or futures trading, refining your skills without risking real money. Learn technical analysis, study macroeconomic indicators, and build confidence before diving in. Exchange rates are more than financial metrics, they're the pulse of the global economy. A misstep in currency policy can trigger trade wars, financial crises, or arbitrage windfalls. Soros's billions came from seeing these dynamics before others, acting decisively, and shaping market outcomes. His story is a call to action. Wealth lies in spotting what the crowd misses. In 2025, as central banks grapple with inflation, debt, and geopolitical uncertainty, The markets are a battlefield of risk and reward. Embrace Soros's audacity, arm yourself with knowledge, and step into the arena. The secrets of financial success are waiting. Will you seize them?